Well, thank you very much. And obviously, they saved the best for last. But of course, I'm not referring to myself. I'm referring to Tara, who is going to be our discussant. And she's a fantastic discussant for this paper because it is early stage, as you will discover. And it is at a perfect point to really benefit from her comments. So what we're going to be doing is examining a new SEC disclosure rule. The pay versus performance disclosure. We have a couple of projects on this, but this one, we're going to be examining this new measure called compensation actually paid. This is joint work. Again, I'm Austin Starkweather at the University of South Carolina, though I'm moving up north a little bit to University of Tennessee, so one SEC school to another this summer. Aiyesha Day at Harvard, Berk Sensoy, Josh White at Vanderbilt are the co-authors on this paper. Now, it is new, but that's not because we're lazy, even though we are, but because this disclosure only came into effect in the last 12 months. All right, so it's a new, brand new 2023 disclosure, but it originated from Dodd-Frank 14 years ago. Yeah, 14 years ago. My watch is right. All right, so so I'm going to try to place us into the literature and kind of into what the media was saying about executive compensation at the time of Dodd-Frank, is it's going to give us a little bit of context to understand what the rule is trying to accomplish. All right, so fortunately, I'm in a safe space and don't have to convince you all that executive compensation is important or that pay versus performance or pay for performance sensitivity is important. Lalitha, do you buy that? Or Naveen? I think I have the two biggest advocates for that right here. And you know, to the part of a high CEO pay, right? There are plenty of advocates for high CEO pay arguing, in general. Well, kind of to summarize, the main thrust is that high CEO pay is going to be a positive NPV investment by the firm, you know, and that they're attracting the best talent. The best talent's going to create value. Now, there are detractors. Right, and I apologize for not listing everyone's paper on here. I know we have some papers in here, including Lily. This Paid for Luck has a paper on that. Detractors are arguing that CEOs are overpaid for various reasons, perhaps paid for luck. Of course, your paper goes in the other direction. You know, pay remains high in economic downturns. All right, so this was attracting particularly great attention immediately after the global financial crisis, which is Dodd-Frank. Right? And then finally, arguments that pay is often rigged to focus on better performing measures. Right? And then in the media, I guess I should say that it wasn't just focused in academia, this argument or debate, but the media was also paying attention. All right? We see the, you know, $1.6 billion of bank bailout went to executives. All right? Moreover, in Congress, right? Henry Waxman, how can a few executives do so well when their companies do so poorly? And so kind of in all of that, we have the pay versus performance disclosure. Now again, 2010 Dodd-Frank Act, right? SEC must pass a rule that requires firms to, quote, disclose compensation actually paid and compare it to the financial performance of the firm and its peers. Now, sometimes rules take a little while to get through, so in 2015, the SEC proposed a rule. Solicited extensive public input. We've read through all of these comment letters, you know, all of the, well, we can't read through the meetings with market participants, but we've talked to market participants. And finally, in 2023, it actually came into effect. So the very first disclosures were only about 12 months ago, right? Passed in August 2022, in effect in 2023. All right. So just to kind of remind us all of what the information environment looked like before and after, right? So before the PVP disclosure, so like in proxy season 2022, we have the compensation discussion analysis, CD&A, where firms are going to discuss their philosophy of compensation. Firms are also going to explain what pay is designed to award. And then also there's the summary compensation table, I'll say SCT. Where firms are providing the salary, the bonus, the equity grants based on the value, grant date value, and then non-equity incentives, other compensation, et cetera. All All right, but after the PVP rule, we still have all of that, but we have a new section, this PVP section, that is going to provide, among other things, a table that will have executive pay for the prior 3 years, including this compensation actually paid metric. All right, so right now I'm just going to give you a very basic overview, and essentially compensation actually paid, this new measure, and I'll go into detail later. It's roughly take the cash-based compensation of an executive in a given year, and then adjust that for the change in the value of all of that executive's unvested equity. Now, there's some exceptions to that, but right now, before I get into more detailed explanation, that's kind of the overview. Right? So this table is going to provide that CAP measure, compensation actually paid. It's going to provide total shareholder return, the TSR for the compensation peer group, net income. It's going to provide this company selected measure, and then this section is also going to provide some most important financial measures, and then also perhaps a discussion. All right, so reading all of the blogs that we could find on this, reading as well all of the comment letters, we found that proponents were generally arguing that this rule would make it easier for investors and other stakeholders to assess executive compensation policy. Also, they argued that it would provide insight into the effect of performance measures on executive compensation. Now, in contrast, the detractors argued that it would have questionable utility, that would simply escalate the complexity. I think Bob was mentioning earlier, I guess plenty of proxies have 100 or more pages, with a CD&A being 50 or more, so definitely understand. And then it could potentially distort incentives, right? Maybe firms would potentially try to game the CAP disclosure, or the CAP value. All right. Okay, so what do we do, right? So this is a new rule. We are trying to present, first off, some determinants of CAP, as well as how the CAP might compare to the summary compensation table figures. Second, we're going to ask and explore the CAP disclosure provides new and useful information to investors. And then third, we're going to explore if and how investors might respond to the CAP disclosure. Sample, we have, I think, spent 1,000 hours of hand collection time that we've overseen during 2023. We have hand collected about 100 different variables, though only about 10 or so will appear in this paper, of firms that submitted a proxy through September of 23 in this version. We're updating it for the rest of the year. And we're looking at CompuStat and CRIS firms that submitted both a proxy and then also the 8K with the vote results. All right, main findings. First, CAP has more variation than the SCT measure, and I'll get into that. CAP is highly influenced by the actual and then also the relative stock performance, which shouldn't be a surprise to us. We know that compensation changes, the equity obviously changes values based on stock returns. Third, CAP provides new insights beyond the prior disclosures and performance-related metrics like delta. Disclosing a negative CAP is met with positive returns, especially when TSR is negative. Now, one unique and fortunate, maybe not for our 401ks, but fortunate for my ability to publish, is the fact that the market had its first double-digit decline in 2022 since, I think, the global financial crisis, right? And this followed 2021 and 2020, which is also being newly disclosed here, in which the market went up by double digits. Right, right. So response reflects investor preferences for pay structures that align with their poor returns. And then finally, CAP disclosure influences say-on-pay voting outcomes. Increase CAP to SCT ratio and anticipate a CAP associate with reduced say-on-pay support, negative CAP, and larger than expected CAPs are linked to increased, say, on-pay support. All right, so what is, well, I'll get to what's in the new CAP measure, but first let's circle back and kind of show you again what's in the summary compensation table. And I'm going to use Moderna, and you'll see why I'm using Moderna. So this is what the summary compensation table looks like. And we can see that the total compensation for the CEO of Moderna is between about 10 and 20 million. Right? And we also know from the literature that equity-based compensation, so the stock and the bonus, is about 60% of overall compensation for CEOs. Right? Now, here we have the PVP table. And so we have, on top we have the summary compensation table again, but down at the bottom, PVP. And so we have the summary compensation total for the CEO, right, with the same numbers that we have up here. Whoops. All right, and then we get to the CAP measure. I'm choosing Moderna for a particular reason in that there was such high volatility in the stock price, and we see some absolutely insane CAP values for compensation actually paid. Right, so according to this metric, the compensation actually paid to Moderna's CEO, well, in 2020, we know that Moderna's stock went up by a lot. Compensation actually paid wasn't this $13 million, but instead $469 million, right? Essentially the change in the equity value. 2021, $793 million. That's all great, but what happened in 2022 when the stock price went down by 30%? Well, they had a compensation actually paid of negative $300 million, right? So I chose an extreme, yes, but to make an example that kind of highlights the variation and the fact that you can have a negative CAP, right? Which, talking to practitioners, some people are having a difficulty, I guess, explaining that, to industry, but, it's an interesting finding that we found. All right, now I'm going to go into the calculation a little bit more, and there's more of that in the paper. So to calculate the CAP, you start with the summary compensation table value. You remove the stock and equity granted that year, right? And then you increase or decrease for changes, various changes in equity values. So first off, you have the year-end fair value of equity granted during the year that remained unvested. Right? Second, you have the change in the fair value of unvested equity awards granted in prior years. And then third, change in the fair value of prior years' equity awards that vested that year. Now, the calculation stops at vesting. Right? So if it vests in June, boom, calculation done. All right, take all of that, and that's how we get to the negative $300 million. And you can see that the bulk of that, negative 311, was from the change in the value of the unvested equity. Just some summary statistics, right? So for our sample, and we're looking at roughly the 2,500 largest firms, 2020 to 2022, summary compensation table mean was about, 8-10 million. But look at this. The CAP mean, 2020, 48 million. Right, so the mean CEO, according to the CAP measure, got $48 million. Now might look like a typo, it's not. The standard deviation in CAP was over $1 billion. I kind of refer to that as the Elon Musk effect. He did very well. I think his 2020 CAP was $40 or $50 billion, something like that. But anyway, it doesn't surprise many of us, I'm sure. 2021, it was $22 million. Now look, in 2022, the market went down on average 18%. But the CAP, it was also lower than the mean of the summary compensation table. And also interesting, the 25th percentile is only about $390,000. Right? So we had about 20% of CEOs in 2022 earn a negative CAP. Right? So takeaways during the years with market gains, surprise, surprise, CAP is greater than SCT. It changes, reverses in 2022. Here's a histogram of what the CAP looks like. And it's been truncated kind of at, I think we truncated about the 5th percentile and 95th percentiles. And this is unconditional, but we're going to break it up into conditional on a positive total shareholder return and then negative total shareholder return. Right? Unsurprisingly, positive total shareholder return. The CAP, it's skewed far to the right. And we have plenty of individuals well above 40 million into the billions or tens of millions, hundreds of millions, et cetera. Now, I don't know what our prior really was in terms of what would the CAP distribution look like for firms that had a negative total shareholder return. Interestingly, we see that there's a pretty good distribution around 0. All right, so if a firm performed poorly, then we do see quite a substantial number of CEOs getting negative CAP. All right, so after we do the summary statistics, and we have more in the paper, we do a determinants test. All right, and the proposal was attempting to link compensation actually paid to total shareholder return. Right? And so what we're going to do is explore the determinants. We're going to test to see if total shareholder return is indeed linked to CAP. We're going to create a number of metrics, CAP divided by SCT, so a ratio, and then a negative CAP value, right, equals 1 for a CAP less than 0. And we have the descriptive statistics there. Right? Takeaways. TSR is indeed the biggest driver. In fact, you might not be surprised to see that the T-stat of 15. So very, very high driver, very important driver of TSR, or excuse me, CAP. But CapEx apparently is associated with lower CAP, and then PEO change with higher CAP, reflecting a lot of the one-time grants. All right. Now, another question might be, is this information actually new? Right, we're finance faculty. We all still have nightmares of when we took asset pricing theory and had to do the Black-Scholes model, or at least I do. And so, we would argue that if we know the number of options that a CEO has, we should be able to calculate that. And I think that there's some truth to that. But I'm also going to present why there are some issues that might make it a little bit more difficult to calculate or estimate the CAP ahead of time. Performance vesting units, we don't really always have that much insight into the targets for the performance vesting units. Second, time intensive. Here's Moderna's CEO's options. I don't want to calculate the change in value of those over the course of a year. All right, so it would take quite a bit of time, which leads to the possibility of rational inattention. Right? Investors might be rationally not paying attention and doing this calculation. All right, so one thing that we did is we created an estimation of CEO CAP in 2022 using other kind of pay-for-performance measures that are out there, including Delta, and we need to incorporate Vega, but we'll do that later on, and some other information. And given the easy-to-obtain information, the adjusted R-square is still below 0.5. Right? So I'd argue that at the very least it's difficult to get a very close approximation of CAP without much effort. All right, investor response to CAP. So what we've done, we have the initial 2 measures, and then we also create an expected CAP based on this model. And then the difference between actual and expected is going to be the unexpected. And we're going to do a number of analyses. First, we're going to look at announcement returns of the proxy filing. And then second, we're going to look at the change in SOP voting support. And the big takeaway is that misery loves company. All right, so the takeaway here, we have this dummy variable on negative. All right, the dummy variable negative CAP takes a value of 1 if the CEO's CAP is negative. If the firm had a, I should say that in alternative analyses, we break it up into firms with negative TSR and positive TSR. But in general, if a firm's CEO has negative CAP, then the firm also had a negative TSR, right? And we see that firms with a negative TSR in which the CEO also has a negative CAP, the investors respond positively when they see that the CEO is suffering along with them. Of course, I mean, if the stock price is down 30%, 0.6% bump might not make you feel all that much better. But knowing that the CEO is suffering will make you just a little bit happier. And then finally, does it influence the say-on-pay voting? And we find that yes, it does, or at least it's associated with, I should say. Right? We find that the CAP to SET ratio, the higher the CAP is related to the summary compensation table figure, the lower the vote. And then also kind of consistent with what we saw on the prior slide, if a firm's CEO has negative CAP, then we're also going to see higher say-on-pay vote. There are some analyses on expected and unexpected, but really we're kind of developing that in our papers, so I'll save that for another day. And with that, we do a deep dive into the PVP disclosures, have a number of findings, but it's a work in progress, and so I think I want to give more time to Tara to help us progress it even further. So thank you.
While my slides are coming up, I'll say thank you to the organizers, thank you to all of you for sticking around, thank you to Austin for kissing up to me. I do have to, point out the disclaimer.
If I had more time, it would have gone a lot farther, and it would have just been embarrassing. So I'm glad they took me off.
I appreciate you didn't have enough time for that. But I have to point out this disclaimer, which says that everything I say today represents my own views and not necessarily those of the Securities and Exchange Commission or my colleagues there. I'll add another disclaimer here, which is that I worked on this rule from the 2015 proposal all the way to the 2022 adoption. So anything you like about this rule, feel free to thank me for. You're very welcome. Anything you don't like about this rule, obviously blame my colleagues. Just kidding, blame Congress. Just kidding. Not exactly kidding, but. For some background, although Austin covered most of this, if any of you have used CEO compensation as a control variable in regression, what you're relying on is a summary compensation table and proxy statements, which has served us very well. It's a very thorough measure. It includes pretty much everything you could think of, even perquisites. And so it's a really great measure when you're looking to assess the level of executive pay. And I stress that word level because what it's not great at is giving us a sense of pay versus performance, right? Giving us a sense of how pay changes over time with performance because it's static. It's fixing the value of these awards at their grant date value, where of course all of the incentive built into these instruments is based on how they change over the following years with the performance of the company. And so in this 2022 pay versus performance rule, which was mandated by Dodd-Frank, we defined this new measure of pay. So this is where the SEC was given a little bit of discretion, even though it was the mandatory rulemaking. And then a number of other elements, as Austin mentioned, I also won't go into them in detail. But I will point out, we found, we looked closely at what the proxy advisors were providing, which has come a long way, and what the compensation consultants were providing to their clients. And honestly, the new measure and analyses were quite similar in many ways to what some of these intermediaries were already providing for institutional investors. And some companies, honestly, were already disclosing voluntarily. So I like to think of this rule a little bit more as democratizing access to this kind of analysis, more so than necessarily introducing something new, but more on that a little bit later. It is a little early. So there have been 3 rounds of interpretive guidance from the SEC already since it's been adopted in 2022, kind of clarifying exactly what we want to see. And I think some of the institutional investors have said, look, and some of the proxy advisors have also said, look, we're not going to look at the first year of data. We just want the dust to settle a little bit. And so it's not, it's not clear that we've really figured out what the best practices in this disclosure are going to be. That said, it's really nice to get early results on this because sometimes we have to wait like 5 or 10 years to hear what people think about our regulations. And so I'm glad that they're on this early, and I think they'll have time to build in a little bit more data as they continue to revise. I want to explain a little bit more of the thinking behind compensation actually paid, and I borrowed this graphic from paid governance in the practitioner literature. Ignore my bad centering here and also ignore the small font. But what we have on the left side is summary compensation table compensation. This is the average by component for, I think it's S&P 500 CEOs. And then all of the adjustments you need to get to compensation actually paid on the right for that same group for this year. If you look at those two gray bars, those are some adjustments mostly having to do with pensions. I would ignore that for now. I'm happy to talk about pension accounting afterwards if anyone is interested. I've spent too many hours of my life on that. But you can see the three most significant bars here are in the center. The orange here is backing out the grant date value of the equity awards given in this year. The darker blue is adding back the value of those awards granted in this year, but now valued as of the end of the year. So kind of normalizing them and taking into account any changes over the course of the year. And then the light blue here, I don't think it will be controversial in this room, but it has been the most controversial, is the change in value of awards that were granted in previous years over the course of this year. So from the beginning to the end of the year, how have those awards changed in value? And so what some people have been saying is, oh, look, you're including in this measure now awards that were not intended for this performance measurement period. How can you do that? And my personal response to that, I can't speak on behalf of the commission, is that, look, that incentive, that option or stock is still there, it's still unvested, it's still changing in value, and so it's still part of the incentives that this executive is bearing. And so, again, yes, that can send you into negative territory sometime, and that can be very large sometimes, but that really is how the value of this compensation package is changing over time. And maybe by looking at this relatively stable summary compensation table number, we have been, not fully understanding or not fully accounting for how volatile what the CEO is actually bearing looks like. So Austin did a great job of going through the findings. They have some great descriptive results to give you a sense of what these disclosures look like. And then they have two main sets of results. One set saying, look, there's some novel information here, and the second set showing the associations with returns and with voting results. What I like about this paper, well, first of all, I love that this team of co-authors in general focuses on issues that have real policy, like very direct policy relevance. And I think that's been true for this whole program today, including the one theory paper, which has helped to justify my life decisions. Thank you. It's given me some clarity about why I am where I am. And also, this is sort of an externality, but I think it has shed light on this new disclosure for all of you, because even if you don't work in compensation, this disclosure is tagged in XBRL, and so it's not too hard to extract some of this data from proxy statements, which is not true of a lot of the other stuff in proxy statements. And even if you just want better coverage for a total compensation variable for firms beyond ExecuComp, that's something that you should be able to do with this new disclosure. So I think it's worth taking a look at it. And as I mentioned earlier, I think it's a timely paper, which we don't always get in regulation. Suggestions. Great questions. I think they've really pinpointed the things that the regulators should care about, right? Like, is there information contained into this disclosure? How are investors going to use it? And so, in a way, they're kind of doing my job for me, so I appreciate that. I do think they could formulate their tests a little bit better to get to the answers to those questions. And it pains me a little bit to criticize a paper that is saying that this rulemaking is basically really great. But I'm really invested in making sure that the results are really reliable. So hopefully I have some constructive comments there. Also, I think they can just go a little bit deeper just because it's fun and useful. On formulating better tests. So I think where we disagree here a little bit is in, how feasible it is to compute compensation actually paid. So, when I looked at this model, my first thought is, why do you have a model? It's formulaic. It's a revaluation, and we have, all of the assumptions buried sometimes in footnotes, but they're in the proxy. It's doable. It's late in the day, so I'll do an analogy. It's as if you had a new Oscars category for cinematic achievement, which was based just on your box office numbers. And you could regress that type of award on whether or not you have a female director, and how much pink is used, and how hot your leading actors are, and whether or not there's a powerful female monologue. But that kind of a regression isn't really going to tell you how surprising the result is, because people could just look at the box office numbers, right? And so I'm worried that this expected, unexpected breakdown, even if it's harder to estimate than I am assuming, it's still not necessarily captured by this kind of a regression. Because again, market participants are doing pretty sophisticated computations right now as it is. I think I've given you the roadmap for this in the rule release, because it goes through in detail like the specific items that could be new, like they have to report the new option valuation assumptions. Have those changed since the grant was made? Is there any kind of a signal maybe in how those assumptions have changed? And so I think there's something to be done here, but I just don't know about the regression. That then spills a little bit into how you relate these the new measure to the outcome variables and how investors are reacting. So if you see now more moviegoers watching that movie that won that box office award that I made up, it could be because they noticed the movie because of the award, or it could be because they just saw it was doing really well at the box office, right? And you can't tell apart what they're reacting to, because there's underlying information in the measure itself that is disclosed elsewhere, apart from the disclosure of the measure. You're really lucky here, not just because you have me as a discussant, but also because in the first year of disclosure, they had to report back years, right? So most companies are reporting 3 years of compensation actually paid. So you can use those previous years as a really good, it depends on how you want to structure the test, but either a placebo test or a baseline to see, was there a relation between this measure and what investors were doing, even when the measure computed in this way was not being disclosed? And how does the relation look different when it is being disclosed? And I feel like that will really let you hone in on the effect of the disclosure and make sure that you can convince people like me that it's not the underlying information in CAP. And now I get to the more fun stuff. I think there's just more you can do. I'm really curious about whether issuers changed their pay practices. This was something people were worried about when the commission was working on the rules. They said, look, you're gonna make people focus too much on this or that, and I didn't really buy it, but it would be nice to see someone actually look at it. And then this one I find really interesting, right? If we're really talking about democratizing access to this analysis, maybe we see less disagreement in vote results, because now everyone is sort of seeing the same picture and understanding these swings in performance the same way. And then with some of the descriptive statistics, I might be a little bit, my bar might be a little bit higher here because I've been reading a lot of the practitioner results on this stuff already, but I feel like as academics, we can go a little bit deeper. So, maybe instead of telling me the average number of graphs in these disclosures, you could tell me, okay, are you more likely to use graphs if the graphs look good? And less likely to use graphs if you just want to write a few sentences of narrative and not focus too much on what the picture would actually look like. The other one here is, CAP is related to TSR. As you said, that's pretty well expected. But, can we look back at the measures we've been using in literature, like delta, and see, like, do they really work well to measure this variation over time now that we have a direct measure of how compensation is changing? And so I think that would be nice to look at and would be a good contribution in terms of understanding how the literature has been affected by not having clean data on this type of thing. So that's all I have. I think there's a lot of potential on this paper, and with a little bit of fixing up, I think it's going to have a lot of impact. So thanks.
Oh, well, thank you very much, Tara. Really appreciate those fantastic comments, and definitely going to help us improve and push along the paper. Kind of the only thing I want to respond to regarding the equation and whether or not it has new information, a lot of kind of the variation that we saw was in the performance-based stock awards, right? And those, you don't know, like, the targets, right? You say if a performance-based stock award is going to be based on, hitting $1 million of revenue, right? We don't know that $1 million revenue number beforehand, right? And so we see a lot of variation, and some of that is not revealed. But I do think that your overall comment of let's really kind of clean up the equation and think about it is absolutely 100% valid, as of all of your other comments. So really appreciate that, and early stage paper, so it's going to improve it a lot. So thank you.
I already got it. Gotta ask. I
think that's Daniel's. I didn't give my. Okay. Yes.
Quickly, yes. So related to the investors' reaction, the market reactions. I understand and I appreciate that you're looking at the proxy filing dates, but proxy filing dates, there's so much information in there. You can't really associate necessarily with a negative or positive number. I suggest here to look at the passage of the proposal in 2015. And you probably would find some cross-sectional variation as well. That was the day that becoming law is different at the end because it was expected to some extent. But the passage date, probably a lot of uncertainty was resolved. And you can look at cross-sectional variation here with regards to quality of corporate governance, whether, for example, firms that have independent comp consultants versus firms that don't, they have affiliated consultants, or versus co-opted boards or not. And how did the market react at that point when this was supposed to become mandatory and being disclosed, given that at the time nobody knew that this is going to go on the back burner, President Trump going to come in, Choice Act 2 going to happen, and try to remove all these Dodd-Frank items from SEC's plan to go through. So that 2015 date is actually pretty valuable to look at.
Yeah, no, great comment. I agree with your comment about using the proxy release as being a noisy measure, and we are doing a lot of stuff to clean that up. Kind of my only response is we're doing what we can to make it as clean as possible. And then, of course, I'm going to say we're not the first ones that are doing it, so no. But great comment. We're working on that.
Hi, I like the idea.
Bob!
Well, Klaus Lewis was mentioned. I should weigh in. We had used realizable compensation versus realized. We used realized instead of realizable. We found that not many of our clients used it. I think part of it was it wasn't comparable. We weren't comparing that against a whole bunch of companies. I think this democratizes it. I love that phrasing.
Me too.
So I think it will be used. I think investors are frankly just still digesting it to try to figure out how to use it. And I think one of the things that this doesn't get to, but I think would be fantastic, would be the whole point of this is to show that these performance metrics are challenging to meet and may not be met. At least that's the whole point to me. Because a lot of companies will say, well, the summary comp table is a snapshot, it's a valuation, but we don't always meet that, and here are some examples. I think if you're able to measure the difficulty of companies' metrics based on what percentage do they actually earn versus what is a summary comp table number, showing this is a very difficult program, this is very challenging metrics, versus one where these metrics are met every single year, that would be extremely valuable to investors.
I like that, yeah.
Any more questions?
Well, I'm surprised that Lalisa and Naveen are not asking questions. I was waiting for you guys.
Lalitha is discussing it in a month at Drexel, so she's saving the good stuff for later.
Yeah, because initially I didn't want to ask any question before they asked the question. But anyway, so they were not. So I'm just wondering, maybe a more accurate, I don't know if I understand it correctly, maybe a more accurate name for this, total compensation, compensation actually paid. Is it just a change of firm-specific wealth? Because in academia, we do use that a lot. Like we see it in a lot of papers. It's basically CEO wealth coming from this company, right? So it seems like just change of this wealth, right? So that's why it includes the stocks and options granted in previous years.
Yes, sir. Oh, sure, go ahead.
So the term compensation.
term compensation actually paid is from Congress. Now,
really
how it
from
was
her.
supposed to be used, it was supposed to be aligned against TSR, and a year-by-year framework was kind of set by them. And so that informed how the commission thought about what measure would make sense to align next to TSR. It is something similar to how CEO wealth is changing, except that it is limited to things that are unvested, because the idea is that that's still compensation. And once things are vested, then it's an investment decision on behalf of the CEO whether they remain invested in the company or whether they diversify away. My views, not the commission's.
Okay, so I think we can conclude today's discussion. Laura and Faye, you want final word?